You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. I'm joined by my co-host, John McEwen, and it's the 18th of April, 2024. On this week's show, we'll be discussing Imperial Brands, Gamma Communications, Tesco, Team17, Unite, and our US company of the week is Upwork. John, do you want to start us off with Imperial Brands?
Yes, so it's one that we've covered quite a few times before. It's the UK's second largest tobacco company. We had a trading statement out last week with the group remaining confident of meeting both half-year and full-year guidance. Excluding the effects of exchange rates, first half underlying operating profit is expected to grow in the low single-digit range. Surprise, surprise. And good tobacco performances in Europe and the Americas have more than offset a softer performance in other markets. Sales growth in the next generation products, which is largely the vapes, is expected to be in the mid to high teens, with operating losses reducing. Full year net revenue is expected to grow in the low single digit range, as mentioned, and operating profits in the mid single digits. Growth is expected to be second half weighted, driven by tobacco price rises made in the first half. Year-end debt levels are expected to land towards the bottom of the 2 to 2.5 range of net debt to underlying cash profit, EBITDA, and there's about 600 million of the 1.1 billion share buyback program for this year, which has been completed so far, and the remainder is expected to complete by the end of October, and shares were broadly flat following the trading statement. In terms of valuation, Imperial Brands has a market cap of around £15 billion and trades at just 5.6 times forward earnings, compared with a 10-year average of 9.5, and it has a prospective dividend yield of 9.2%. I don't think there's a huge amount to say about this trading statement, really. It's in line with guidance, and I think what really stands out is just how cheap these shares are at 5.6 times forward earnings with a huge dividend of 9.2%. I don't think anybody's expecting that to continue indefinitely. Volumes, as we know, with both Imperial Brands and British American Tobacco are falling. Decent growth when it comes to the vapes and the next generation products, however, much less profitable, and they, of their own, have an uncertain future. And certainly, nothing like the margins on the traditional combustibles, which, as we know, structural decline as fewer people are smoking. So the business, longer term, clearly in structural decline. And if it has anything, that would be a bonus for Imperial shareholders. I suppose if someone were to make the investment case, ethical concerns aside, it would be that essentially they're returning a huge amount of cash to shareholders, both in the form of dividends and through share buybacks. So even if it did go bust in 10, 15 years' time, if they return as much cash as they currently are for a lot of that period, then someone could do well on the shares purely on that basis, assuming they weren't just reinvesting it all. I don't think there's probably much more to say about it than that. Imperial is the smallest of the big five, and there's always speculation. Could it be a target for a takeover? It's already quite a consolidated market, so it doesn't seem that likely. Sam, anything more to add on Imperial in this trading statement?
Not massively. I think in terms of Imperial, you've covered it. In terms of the price, I just think you can get British American Tobacco for 6 times earnings. You get a 10% yield, which is actually, I think, slightly higher. And British American, I think, has the better next generation business anyway. So I don't know why you wouldn't just get British American. I think I would much rather have that of the two. I think you can make a very, very strong argument for Imperial based on valuation, but you can also make the same argument for British American, and that's the better company, and they're about the same value of about the same dividend. So to me, British American seems like more of a no-brainer than Imperial if you're picking between the two.
On to our next company, which is delivering on growth, or we hope so.
Yes, so Gamma Communications, it's one we've covered before. It's one I'm a shareholder of. They sort of do telecommunications stuff, and it's kind of like it's stuff that sits in the background. So the best example is if I've got a phone at work and it will say on the screen of the phone, SIP trunk. I don't really know what it is anymore. I did know 2 years ago, but I've forgotten. But that SIP trunk, that's the kind of technology that Gamma has in the background for stuff like that, for like a lot of business to business stuff like that. So they are listed on the AIM, and we've covered them a few times. They have come out with their full year results for the year ended 31 December 2023. And revenue was up 8% to 521 million. Gross profit was up 8% to 267 million. Gross margin was flat at 51%. Adjusted EBITDA was up 9% to 114.3 million. Profit before tax was up 10% to 71.5 million. Earnings per share were up 8% to 54.9p, and adjusted earnings per share were up 5% to 75.1p. Total dividend was up 14% to 17.1p, and the cash generated by operations was up 25% to 123.5 million, giving an adjusted cash conversion rate of 108%. And the net cash position at the end of the year was 134 million, up 46% from a year ago. They completed 3 acquisitions in the year. Satisnet in August 2023, a leading provider of cybersecurity services and solutions. Enable X Group in December 2023, giving us a relationship with Ericsson LG and access to their UCaaS solution. IPEX and Coolwave Communications in February 2024, an international SMS and voice services provider, allowing us to provide Operator Connect and other carrier services in nearly 20 countries. Through these acquisitions and strengthening existing partnerships, we intend to have a full UCaaS portfolio with our in-house developed product suite, PhoneLine Plus for micro businesses, Horizon and IPEX for SME, and a Cisco suite for larger SME and enterprise customers. Most of these can be integrated with Teams. After applying the board's capital allocation framework, we are announcing an intention to launch a share buyback program of 35 million to be executed over the next 6 months. Recurring revenue was up 7% and remains at 89% of total revenue. The European business delivered gross profit growth of 11% to 38.5 million, and that's 38.5 million on total gross profit of 267 million. So the majority of it is still from UK. 8% excluding foreign exchange movements, with gross margin improving from 47.4% to 48.5%, supported by the successful integration of Neotel acquired in 2022. They said the profit before tax, which increased by 10%, was after a 12.7 million non-cash exceptional impairment of development costs, intangible assets, and 3.3 million of non-recurring exceptional restructuring costs. Cash generated by operations increased by 25% to 123.5 million, as mentioned before. And they've said that was primarily a result of favourable working capital movements, in particular the effect of some prepayments in 2022, not repeated in 2023. This underpinned a net cash increase of 46% to 134.8 million, achieved after total payments of 30.5 million related to acquisitions and 15.2 million paid as dividends in the year. In terms of the valuation, the business trades at a P of 24 and has a dividend yield of 1.3%, and the market cap is 1.28 billion. I think these are a good set of results. One thing I've liked about the business that we've previously highlighted is, they've got quite a good acquisition strategy, very smart at, looking for good companies to acquire, be it in the UK or in Europe. And they're paying for these acquisitions out of retained profits. They're not taking on debt to do this. It looks like they're starting to run out of things to acquire, given that the dividend's up 17% and they've initiated a buyback program, which is, about the amount they'd normally use for kind of acquisitions in a year. That's fine. I think that's good management. I think if they're not seeing the opportunities they were seeing 2 or 3 years ago, I'm very happy with them just distributing that to shareholders. The main issue I have with this business, and I think these results are decent, but the main issue I have is that I struggle to understand it. I spent a good amount of time, as I mentioned a couple of years ago, going through it and trying to get my head around it. I didn't really achieve it very well. It hasn't stuck. And then like a year ago on the show, I interviewed a guy who worked in cybersecurity. I interviewed him and he worked in cybersecurity and he said he used to own it. And then one day he sort of looked at it and thought, I don't even understand this. So he got rid of it. And I just kind of think, so it's basically, it's down about 5% for me or something since I bought it. I'm probably flat with dividends, but I just think if he doesn't understand it, I definitely don't understand it. I'm not pretending I do, but I know we have this discussion every time, but I'm kind of thinking, well, should I just get rid of it and buy something that I do understand? But then at the same time, it is delivering. So there has to be a lot of trust in management. But I don't, I struggle to understand what the business does. And I think that is obviously not wise. But I hold it. So it's not really felt like a good enough reason to get rid of it. I definitely wouldn't buy it now because I don't understand it. But I don't know if it's a good enough reason to sell it. So it's a bit of a funny one for me. But the results were good. So, John, what are your thoughts?
Yeah, I suppose it's difficult as a sort of retail investor with companies that are very specialised like this. Again, I don't think you can argue that it's not delivering. Guess it's a bit on the pricier side, but it's the type of company that's continuing to deliver, and they do seem to be well run. I can't get my head around it. I probably wouldn't invest for that reason, but it's very interesting and interesting to see it, I guess, a British tech company.
Maybe at
Or
some
maybe
point.
maybe you call it telecommunications, but it's close enough.
Yeah. Right. Should we move on to a business that is much easier to understand?
Yes, and one that I used to own, and I sort of now every time we see it, it does continue to deliver. It's Tesco's, Britain's largest retailer. They had their full year results out last week, with Tesco's sales rising 7.2% to £61.5 billion last year, ignoring the effects of exchange rates, and performance was helped by rising volumes, which offset the effects of easing inflation in the UK retail market. Revenue was lower than the market expected, primarily due to lower fuel prices impacting on overall sales. Underlying operating profit for the group increased by 12.7% to £2.8 billion, and this was led by stronger than expected volumes and a further £640 million worth of savings. Net debt reduced by 6.9% to £9.8 billion, despite a 3.3% drop in free cash flow and the proceeds from the sale of Tesco's bank. From the new financial year, Tesco expects a marginal improvement in retail adjusted operating profit, and retail free cash flow is expected to land within the range of between £1.4 and £1.8 billion, a fall from last year. A final dividend of 8.25 pence per share was announced, taking the full year payment to 12.10p, and that's up 11% on last year. And a new buyback of £1 billion will take place over the next 12 months. And the shares were largely flat in the early trading. In terms of valuation, Tesco's has a market cap of £19.7 billion and trades at 11.2 times forward earnings, compared with a 10-year average of 12.5, and it has a prospective dividend yield of 4.5%. I thought these results were decent, and consistently now over the last couple of years since COVID, Tesco's has been in a much, much healthier state, continuing to deliver. It's a much leaner business since Dave Lewis, was there and really turned it around. I think, as you previously pointed out, Sam, when you had a lot of the bloat in the supermarkets and owning all sorts of businesses that aren't related to the core business, a bit like their bank, they've got a decent amount of money for it. They've sold it to Barclays and they've got more cash to invest in the core business. If you were being critical, despite it being very, very well run and generating huge profits, which has bumped up that dividend, you would question, I suppose, where the growth comes from. They are businesses that have tried to expand and grow in the past, and that's largely been in places like the States, Europe, Thailand, and failed in the States and generally didn't work out too well abroad. They also tried buying gyms, buying coffee shops, buying restaurants, and again, none of that worked. So whilst they are much better businesses now, it's difficult to probably get excited about them. Then again, that is reflected in the price. So 11.2 times earnings, or times forward earnings, is not expensive, and it's a very good business. Do I regret selling it? Probably not. I think there are better businesses with more growth out there. And I did buy in 2013, and I probably broke even or came close to breaking even when taking into account all of the dividends, particularly when they sold the Thai business. But it's still below the share price back over 10 years ago now. So I think that probably tells you something. Sam, what are your thoughts on these results from Tesco's?
I think they're decent. I think operating profit rise is really the most impressive, but that has mainly come from cost savings, and you can only cut that so far. Very happy with the sale of the bank. I think it was, like you said, it was almost like a hangover from that mid-noughties era when they were trying to do everything. I think the only criticism I would have of it is I think on 2.8 billion of operating profit, I think 9.8 billion of debt's quite high. Sort of between that range of 3 and 4x, where you need a good reason for it. And I'm not sure they do have a very good reason for it. Now, I think a quality business like Tesco, over the, we've covered it for a few years on the show, and it's been pretty consistent in putting up good results. I certainly wouldn't be concerned about the debt, and I don't think they're not going to be able to repay it or anything. But I kind of think it's at a level where it's quite high. They must be paying quite a lot in interest, unless they've got it all locked in at a really low rate. I don't know. But I just kind of think, why are they spending $1 billion buying back shares instead of just paying off debt? I'd rather, if I was a shareholder, I would rather see them do that. But that is with the caveat that it's in that range of 3 to 4x operating profit that I don't like, but it doesn't make it unbuyable. So I am just kind of nitpicking, because in terms of the performance, it is very good. And I do agree that 11 times PE with a 4.5% dividend yield, I think that's pretty fair for a business that's probably not going to grow.
On to Team17 then.
Yes, another AIM-listed stock that we have covered before. So they are the video game maker, but they are really best known for the Worms games, which I think Worms are still going, but I think, if you're probably born between maybe like 1990 and 2000, that's probably the age group where you will know it very well. But they have come out with their full year results for the year ended 31 December 2023, and revenue is up 12% to 159 million. Gross profit was down 17% to 57.5 million, and the gross profit margin dropped from 49% to 36%. Adjusted EBITDA was down 39% to 29.9 million, and the basic earnings per share swung from 16.5p to a 2.6p loss per share, although they did have a 17.5p earnings per share when they adjusted it. The operating cash conversion was 87%, down from 108, and cash and equivalents was down from 50.8 to 42.8 million. And they've said the review of the carrying value of intangible assets resulting in a one-off non-cash charge of 11.1 million relating to games titles impairment, and a 20.9 million goodwill impairment charge relating to the acquisition of the label. Now, that's quite good on the one hand, because the impairment isn't actually cash, although it is cash they've already spent. But what impairment is they've bought something, it's gone on the balance sheet, and then they've looked at it a couple of years later and said, actually, it's not worth what we paid for it. We're going to have to write it off. And that's then gone through as a loss in the P&L. So it's not good that someone's looked at it and decided that some of these games are not worth as much as they thought when they bought them. In terms of the operations, they had 17 new games and apps released in the period, along with 6 existing games released on additional platforms. Revenue from the back catalogue grew 10%, and they account for 71% of group revenues, and that's down from 73% a year ago. While the group's first-party IP represented 35% of total revenues, down from 40% a year ago. Games label showed revenue growth of 12%, launching 11 new games, including the multi-award-winning 2023 game Dredge, which has sold over 1 million units, along with Blasphemous 2, Headbanners, Rhythm Royal, Killer Frequency, Moving Out 2, and Treepang 2. In addition, 5 existing titles released onto new platforms. Game Label's content portfolio now comprises over 500 digital revenue lines, and that's up from 700 a year ago. Star Toys posted revenue growth of 26%, developed and launched 3 new apps, including Barbie Colors Creation, Lego Duplo, Disney, Mickey and Friends, and Marvel HQ, and 327 apps updates across its existing titles, up from 216 a year ago. Active subscribers continue to grow and now exceeds 320,000. A thorough review of the games label strategic direction, now refocused on its core indie games roots, cost base, structure, and processes, was completed in the last quarter. Headcount reduced to 348 from 392 a year ago, reflecting the impact of the games label restructuring review and increased utilization of an outsourced studio resourcing model. In the outlook, they said they have a solid pipeline of at least 10 new games and apps expected to launch in 2024 financial year, skewed towards third-party IP and beyond, and we will continue to use our exceptional lifecycle management capabilities to drive sales growth across our back catalogues. In addition, an action plan is in place to accelerate revenue and profit growth, which includes increasing the proportion of revenues from first-party IP over time, sharpening our greenlight process, more innovative marketing and publishing models, while pursuing an active M&A agenda. We remain confident that the group can deliver an improved underlying trading performance in 2024 in line with current market expectations, and remains well positioned for continued growth over the mid to long term. In terms of the valuation, the business trades at a P ratio of 14 and doesn't pay a dividend, and it has a market cap of 364 million. Now, this might sound quite low, John, and the reason is we've not covered it for a while. In the last 3 years, it is down 68%.
Yeah.
And it had a high of over £8 a share, and it's now at £2.55.
It's certainly, well, cheap for the sector, but it's really difficult to know with it. I think is about 70% of its revenue comes from the back catalogue. I suppose a
Yes.
lot of things are really going to be based on what that pipeline is like, almost like a pharmaceutical, I guess, and how much, whether they can have any, anything going viral or any real big blockbusters in the first party rather than that lower margin third party game development. I just don't know. I like Worms, but I don't know how long that can go for, with all of that back catalogue. And I suppose that is reflected in the price. Yeah, really tricky to know. It's not one that I would be buying.
I would agree. I mean, when we covered this in the past, maybe a couple of years ago, and we did look through some of the titles, and if you strip out Worms, not really anything that I recognise. Now I don't play video games, so I'm maybe not the best person. And with Worms, it's just purely a nostalgia thing because I did really enjoy it when I was about 10, but I haven't played it for 15, 20 years. So if I was to get a video game maker, I'd probably pay up for something like EA. Because you go through the EA catalog, and I don't play video games, but if I go through the EA catalog, it's like I know that game, I know that game. I mean, they've got the Battlefield games. They've got what was FIFA, but now FC24, but with them saving 150 million a year for the license. They've got the Star Wars games, and you just go through, and it's quality game after quality game after quality game. Now, I appreciate that's why EA is worth like tens of billions, and Team17 is worth in the millions. However, I'd rather pay up and pay more for those quality games than just sort of what would really for me be like a nostalgia play. Because apart from Worms, I don't know any of the titles, and I think I'd need to sort of recognize some of the titles to have a little bit of comfort over what I was buying, and I just can't get that. So for me, it doesn't really matter how cheap it is because I don't really have any way of checking the quality of the games and whether they've got any that are likely to sort of there's not. I couldn't look through next year's lineup of games they're working on and be like, oh, that's going to be a big one. I've just got no idea.
Yeah, no, absolutely. Okay, then on to Unite, which we haven't covered for quite some time. It was just a Q1 trading update. So it's the student accommodation manager and developer. And they've said that they're still confident in hitting the rental growth targets for the next academic year, whilst property values held more or less stable in the first quarter. The company reiterated its guidance to deliver rental growth of at least 6% for the 2024-2025 academic year, down from 7.4% last year. Demand is said to be strong, with the percentage of beds sold for the upcoming year rising to 86% by the 31st of March, up from 80% at the time of the full year results in February, though down from the 90% at the same time a year before. By the end of March, Unite UK Student Accommodation Fund was valued at 2.98 billion, which is a 0.5% reduction on a like-for-like basis, as rental growth of 1.7% was offset by a 2% negative impact from the loss of the multiple dwelling relief, the tax relief that had been abolished as a part of the spring budget, which benefited a number of Unite's properties. Meanwhile, the London Student Accommodation joint venture valuation increased by 0.8% to £1.94 billion, as 1.3% rental growth offset the 0.3% negative impact of losing the MDR. And the group said student demand is strong for the 24-25 sales cycle, reflecting the continued appeal of the fixed price, all-inclusive offer and a growing shortage of high-quality student homes. And together with their alignment to the UK's strongest universities, this supports a positive outlook for rental growth in the 24-25 academic year and underpins their property valuations. In terms of valuation, the group trades at 21 times earnings with a yield of 3.85%. I thought these results were a bit disappointing, and I think I would have concerns that it does have a significant amount of debt. And with interest rates being where they are, I have a bit of an issue with that. In terms of the growth ahead, I suppose the UK, fairly saturated. It had experienced a lot of growth, and United done very well over the last 10 or 15 years, particularly with foreign students coming to the UK. I think that growth has slowed, And it's not a business that I'd really be jumping at, and particularly at the current valuation. So no, it would be not one for me, I don't think, Sam.
I have to agree. I don't really have a huge amount more to add other than I think for the results it's putting up and what it is, I think it's quite expensive. I don't think I'd
Yeah,
pay a PE of 21 for it. So it's just, it
yeah,
doesn't particularly interest me anyway, but definitely not a PE of 21. I mean, it's just not for me. I mean, maybe if I dug into it, there'd be a reason why it's worth paying up for, but I just wouldn't get that far.
yeah. Fair enough. Okay, on to a business that you do own.
Yes, another business that I own. So Upwork, they have, well, it's actually, these results are actually 2 months old now, but the problem is when Upwork report, they report at the same time as companies like Disney and PayPal, which we tend to cover instead. So when it's less companies reporting, I usually go back and have a look through them. So Upwork, they are the outsourcing company. They have come out with their full year results. Well, they did 2 months ago. And revenue grew 11% year over year to 689 million for the 2023 year. Active clients grew 5% year over year to 851,000, which was an all-time high. Net income was 46.9 million, and all these figures are in dollars, which compares to a net loss of 89 million a year ago. Diluted earnings per share was 6 cents compared to a loss of 69 cents a year ago. Adjusted EBITDA was 73.1 million compared to a loss of 4 million a year ago. Cash provided by operating activities was 27.2 million compared to 6.6 million a year ago. Adjusted free cash flow was 48 million compared to an outflow of 2 million a year ago. And they've said they've advanced Upwork as the premier destination for AI related talent and work, with gross sales volume from AI work growing 70% year over year. They have an enhanced suite of ads and monetization tools, which is their fastest growing revenue stream in 2023. They strengthened their enterprise suite offering and enhanced go-to-market motion, helping add 31 new enterprise clients in the fourth quarter. For their guidance, they've guided for the 2024 year revenue of 760 to 780 million, which would represent 11.7% growth at the midpoint. Adjusted EBITDA of 125 to 135 million. Non-GAAP diluted earnings per share of 77 cents to 81 cents. And stock-based compensation is expected to average slightly more than 20 million per quarter. I thought the stock-based compensation is actually quite high, considering it's a company that's only worth 1.5 billion if you're doing 80 million of stock-based compensation a year, but that is just sort of the nature of the industry, and it's an American tech company, but it's still annoying. But anyway, so in terms of valuation, it trades at it now has a PE ratio for anyone who was interested. So it has a PE ratio of 187 and doesn't pay a dividend and trades at a market cap of 1.54 billion. Now, what I find very interesting is if you take the guidance and you take that non-GAAP diluted earnings per share, and appreciate that is non-GAAP, so it's not statutory. But if you take the midpoint of that and then use the current share price, that would give it a forward PE of just 14.25. And I think at a 1.5 billion market cap, it's still, I think, in an industry that I would think has a lot of growth ahead of it. I think it's really, really cheap. And it's a stock I'd like to add actually in the future. I haven't recently because there's just been a lot of my stocks have been at quite attractive prices. So I've just added to other things. So I've added to Etsy and PayPal quite significantly recently. But I think I would like to add at these kind of prices because I think at a forward PE of 14 and with such a small market cap in what I think will be such a growth industry. And these are, I mean, it's not the figures it was putting up in COVID, but these are decent figures as well. 11% revenue growth. But then that's when it's, all the other sort of stuff is moving in the right direction in terms of net income, client numbers, free cash flow, everything. It's really starting to turn into quite a profitable business by the looks of it. So yeah, I'm very happy with it. John, as someone who's less biased, what are your thoughts?
Yeah, well, I would actually tend to agree with you, and I say it every time we cover it, or every time we've covered it in the last couple of years since COVID. It does appear reasonably priced, and and this is a question for you as someone who owns it. Why do you think the shares have reacted as they have? I appreciate we had, they were everything was going up, and particularly anything tech during COVID and the lockdowns, and some of it were the fundamentals, but a lot of it by, I suppose, more speculation and momentum investing in it. But why do you think the share price is quite so low, given that the figures are, pretty reasonable?
I'm not 100% sure. So it did peak at about $60 a share. It's now at 11. I think it's because the growth has slowed so much. Like the growth has dropped from sort of 60% to 11. Now, I do think this could still be a huge growth industry. And I do still think there is possibly some lag because they had such high growth in COVID. Now, the good thing is it's so reasonably priced that if I'm wrong, that doesn't matter. But I think people would need to buy this kind of thinking, well, it might only grow 10% a year for the next 5 years. Now, I would hope it would do more. But if it does, it's still very reasonably priced. But I think because it was one of those growth stocks, it's kind of had to undergo maybe, I don't know if there's a bit of a sentiment issue where the people that were buying it for the growth have gone and dumped it. And maybe like a lot of value investors just haven't taken a look at it because, if you're a value investor, I appreciate some are more sophisticated than others, but a lot of people would be put off by the PE ratio of 187. Also, a lot of people in the pandemic did prefer Fiverr. That went up a lot more. And that was growing at a higher rate, and that's dropped down even further. So that's dropped from about $300 a share to 20. I was looking at Fiverr earlier. I think they've actually, so I've not dug into details. We might have to do it on a future show. But I think they've actually had a decline in the client numbers. Now, Upwork don't have that. They grew 5%. So there's, it's probably got the better set of results out of them, which is maybe why it's fallen. And also it's the market leader, but that's maybe why it's fallen less, although it has still fallen a huge amount. I would guess for those reasons, but it's the same kind of conversation we're having, when we covered Etsy like a month ago or whenever we last covered it or 2 months ago, where, it's pumping out all this cash, buying back shares and stuff. And it's like, you're almost looking at it and thinking, well, what's wrong with it? But, we're covering this a few times a year and we've covered it for years now. And I don't think there is anything wrong with it. I think it's just cheap.
Yeah. Yeah, it's interesting. Because, I'm certainly, as I said to you before, Etsy and Upwork and even Fiverr, appreciate the recent results haven't been so good, but they are they are at appealing prices for the
quality
of the
they don't need to be that good because I think you have quite a lot of downside protection. I think this could stay flat for 5 years. It's still fairly cheap now. If it's at a forward P of 14, providing it hits those figures, compared to what it was when you were buying it at 60. But
yeah, no, absolutely.
I think that's just partly, it's just the way Mr. Market works, isn't it?
Well, absolutely, that's right. But it's interesting just to speculate as to why the market is viewing it as it is.
So of the 6 businesses then, Imperial Brands, Gamma Communications, Tesco, Team17, Unite and Upwork, which do you like the most and which do you like the least?
I would probably go for Upwork as my first choice, and then probably Unite. That'll probably come last.
Without meaning to sound boring, it would be probably the same.
Yeah.
I did consider Team17 for last, but I just think with Team17, it's still quite cheap though.
Yeah.
Maybe the poorer quality titles is reflected in the price.
That's right. And you could speculate a little bit when it comes to what the pipeline is like. And if one of those, was it 10 games, that does come off, then it's certainly very, very cheap. But I appreciate that's by no means guaranteed. But still, you've got some protection in the sense that 70% of the revenue comes from the whole back catalogue.
Yeah.
Well, thank you again for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.